So you're thinking those primary, those tier one, tier two markets are going to be the focal point for many of these lenders, therefore saying, hey, there's less risk, there's more certainty by going to these tier one, tier two markets. Tier one market would be like an LA, New York, Chicago. Tier two market would be like a Denver, Dallas, Phoenix, something like this. What, from your perspective, on the sales side of it, what are you seeing as far as changes in the amount of transactions that are happening or the valuation of those individual transactions? You mentioned that deals are still getting done. We're seeing that people are having to bring more leverage, but how is that impacting the actual sales value right now? Or is there any anticipation that that's going to happen in the future?
Yeah. I mean, we saw this starting about 90 days ago, and it started with deals that were under contract, that as rates were moving against the buyers and the borrowers, they were realizing that their leverage just wasn't what they thought it was when they put the deal under contract. And so they began asking for price discounts and they began getting them. And I think what we've seen now is with fewer institutional buyers playing, there are just fewer bidders out there. And so what used to garner 40 best and final bids might be getting a dozen or half a dozen today. And the qualifying, factors of those they're going to be much wider. Whereas everyone used to be sort of right on top of each other, and it was just highest price wins with the most amount of hard money down day one. I think you're starting to see buyers flex their muscles a little bit and use a little bit of leverage and saying, look, we know that the buyer pool is a little bit more thin right now, so we're not going to negotiate against ourselves. And they're coming in just at lower price points, lower hard money deposits down, maybe longer escrows, more contingencies if they can get them. And listen, I still think ultimately it's a seller's market, but it's an opportunity for buyers to maybe get a little bit of a break compared to what we've seen, especially over the last 3 to 5 years.
Yeah, that makes a lot of sense. I mean, as rates go up and leverage goes down, the returns that investors are going to have to expect moving forward are going to be reduced. What we've been seeing is that the exact same deal that may have produced a pro forma of a 17% IRR over 5 years might be a 14 or a 15. And that's just the reality that we're in. And it may move further down depending on how high those rates go. There's still a strong argument about why to continue to own and buy multifamily real estate, commercial real estate, and what makes sense there. But with that, your risk versus reward goes away, and it starts making a lot more sense to start looking at what options are available in the market where I can get a pretty darn good return, where I can get most of the return I normally get while taking much less risk. What are you seeing are some of those opportunities?
Before we get into that, just piggyback on that point. One thing that we've been accustomed to over the last couple of years specifically is short-term holds and the easy exit, right? That quick flip, do a business plan. I mean, we have clients who are buying 200 unit apartment buildings, turning 50 to 75 of the units, not even making it, halfway through their business plan, putting it on the market because, someone's telling them they'll pay almost double what they paid for it 18 months earlier. And they're leaving at a 2x multiple and returning all the capital to their investors. I mean, the market dynamics have just changed. As an investor myself, and as someone who's underwriting deals, I don't think that exists anymore. And I don't think we should be, expecting it as investors. And so I think what we need to be doing instead is looking at assets as potential long-term holds. I understand that there could be opportunities to sell in 3, 5, 7 years, but you want to, in my opinion, I think you should be looking at in-place cash flow, today's leverage, make sure that you're okay in the event that you do need to refinance, quicker than you might imagine, but really looking at things with a little bit of a harder magnifying glass, to make sure that you can stay in this deal long-term, even if things get bumpy. So no matter what the market is in 3 years, you're not having to exit and you don't have a gun to your head to either refinance or put it on the market and take a bath. So I think, as you put, investors need to learn to expect lower returns. Part of that is it could be a longer duration, right? It could be similar annual cash on cash, but you're getting it over a longer duration, so your IRR is not as high. So there are some tweaks, I think, just to the psyche of the investor that we need to be expressing and make sure that people are on board with. But part of it starts with underwriting deals in a little bit more of a conservative manner and not anticipating certain rent growth potentially, and also just not that quick exit.
For so long, people have been saying they've been underwriting things quite conservatively, but with very, very high growth. And in today's market, to be conservative, you really have to pull back dramatically on that growth. From your perspective, what are you seeing that growth looks like over the near term and over the long term?
So I think in multifamily, it's difficult because it's so market specific. And again, we have a lot of data points. We track rent growth in every market that we have a loan. We track expense growth. We track NOI growth, and then we do sort of average and cumulative cap rate compression and increasing. Rent growth will be ultimately the dictator of, in my opinion, a good investment versus a poor investment over the next 24 to 36 months. There are certain markets, I think, that will outpace inflation. And if they do that, you have a winner on your hands. And if you're in a place that's more of a sort of a stagnating or a stabilized or mature market, inflation is going to eat away at your cash flow ultimately. But it's what you want. I think cash flow carries the day for a lot of investors through tough times. And of course, appreciation is the cherry on top. But the trade-off today, you might be able to get a slight discount on a property in a tier 1 market that's going to appreciate over the long term in exchange for giving up some of that cash flow short term.
Thank you for listening to the Investor Mindset Podcast. If you like what you heard, make sure to rate, review, subscribe, and share with a friend. Head over to theinvestormindset.com to join the Insider Club, where we share tools and strategies from the top investors and entrepreneurs on how to take it to the next level.